Hello, savvy investors. Welcome back to the Dividend Uncle. Today, we're unlocking the mysteries of Keppel DC REIT, or REIT, the pioneer of data center REITs in Asia. A powerhouse with 19 data centers across 8 countries, a market cap of 3.3 billion Singapore dollars, and a tantalizing dividend yield of 5.4%. However, many investors have held back, pondering the fate of this data center giant, following the recent 20% tumble in share price over a few days. Keppel DC REIT has been lingering under the shadows of a decline in distribution per unit, or DPU, and the risk of tenant bankruptcy. Although it has since recovered some of the losses alongside the recovery of the REIT sector, the burning question persists: will Keppel DC REIT remain the shadows, or is there potential for a triumphant comeback in the REIT's recovery? To unravel this mystery, we're delving into the 2 significant risks that could shape Keppel DC REIT's destiny in the coming months. And, of course, I'll be sharing the Dividend Uncle's candid take on this REIT. Stay tuned, as I currently stand on the sidelines, and I'll reveal whether Keppel DC REIT has convinced me to make a move with my own hard-earned cash. Before I start, I wanted to take the opportunity to update you on Webull's latest promotion. Until 7 December only, if you use my exclusive link in the description section of the video, you'll get to win 10 free shares, worth $80 to $5,000. Just fund your account for 30 days, any amount. Additionally, there's also a Moneyball promotion where you can earn up to $3,000 cash vouchers by funding more. Now, with that exciting news, let's get down to business. First big risk: interest expenses. Let's dive into the Q2 FY23 performance. Gross revenue managed at 0.5% increase to 70.7 million Singapore dollars, a symphony of acquisitions playing a significant role, and net property income climbed by 0.8% to 64.6 million Singapore dollars. All looks well, until we get to the metric most important to dividend investors, the distribution per unit, or DPU. It dipped by 3.6% to 0.02492 Singapore dollars. The main culprit? A jump in the interest expenses by 56.9% to 12.8 million Singapore dollars. Almost all REITs have been affected by higher interest rates, but the impact on Keppel DC REIT seems exceptional. Its average interest rate has jumped from 2.3% to 3.5% in 1 year. To be clear, the property portfolio was a cauldron of strength. The portfolio has a high 98.3% occupancy rate, witnessed positive rental reversions in all countries of operations. The WALE is long at 7.8 years, a consequence of strategic lease maneuvers. The balance sheet? Robust. An aggregate leverage ratio of 37.2%, an interest coverage ratio boasting 5.4 times, and a well-staggered debt maturity profile, its financial fortitude in action. Keppel DC REIT boasts commendable operational performance, establishing a robust foundation that investors find appealing. Now, the critical question arises: will the challenge of interest expenses persist for Keppel DC REIT in the future? Keep that question in mind as I disclose my views later in the discussion. Second big risk: potential bankruptcy of a major tenant. I know what you are thinking. No, we are not talking about Citra. The bankruptcy of Citra has minimal impact on Keppel DC REIT as its exposure is quite limited. In fact, it helped Keppel DC REIT gain a foot up on its REIT rival, Digital Core REIT. But, a subplot of risk is arising for Keppel DC REIT. The potential bankruptcy of tenant Neo Telemedia is on the horizon. Neo Telemedia, the master lessee of several of Keppel DC REIT's data centers in Guangdong, China. Neo Telemedia accounts for about 10 to 11% of Keppel DC REIT's revenue, and a worst-case scenario could see 16% of Keppel DC REIT's DPU be impacted should Neo Telemedia go bankrupt. So you can see that this is potentially significant. The data centers in questions were only acquired by Keppel DC REIT last year, causing investors to reconsider the REIT management's decision and due diligence on the properties. Even though Keppel DC REIT stated that Neo Telemedia has been current with its rental payments so far, and that the risk of Neo Telemedia's bankruptcy is not imminent, it is still a potential threat that Keppel DC REIT's investors must be keenly aware of. The Dividend Uncle's take. Now, let's cut to the chase and talk about what really matters: my take on Keppel DC REIT. First, let me address the elephant in the room: the dual risks of interest expenses and the potential bankruptcy of a major tenant. Interest expenses unveiled. While Keppel DC REIT showcased an impressive Q2 FY23 performance, the 56.9% surge in interest expenses raised eyebrows. However, here's the scoop: Keppel DC REIT has a robust plan. With 72% fixed-rate loans and only a small fraction due for refinancing in 2024, the impact of interest rate changes might be less ominous than it seems. Management forecasts a manageable 2.4% hit on DPU with a 100 basis points increase in interest rates, and with rates showing signs of stabilization, the storm might be weathered. Tenant troubles? Now, let's talk about Neo-Telemedia. The potential bankruptcy of this major tenant has been on investors' minds, and rightly so. Accounting for around 10 to 11% of Keppel DC REIT's revenue, a worst-case scenario could affect up to 16% of DPU. However, it's not doomsday yet. Neo-Telemedia has been meeting its rental obligations, and Keppel DC REIT has a solid plan in place should things take a turn. Keppel DC REIT has the capabilities to take over the master leases from Neo-Telemedia and manage the data centers on its own. The verdict. So, do these risks spell doom for Keppel DC REIT? In my humble opinion, no. The interest rate surge might ease, and the tenant risk, though looming, is not an imminent threat. Keppel DC REIT, with its high-quality portfolio, robust sponsor backing, and a strategic position in the data center sector, appears to be more resilient than the recent dips in share price suggest. While short-term challenges may persist, especially if tenant issues rattle the market, I see an opportunity for long-term investors. I'm considering initiating a small position in Keppel DC REIT, ready to accumulate more during market weaknesses, especially if the tenant risk issues start to spook markets. Conclusion. So, will Keppel DC REIT remain in the shadows of the REIT's recovery? Not in my book. Keppel DC REIT holds the potential to reclaim its throne in the long run. A data center virtuoso, backed by a robust sponsor, it faces short-term challenges, but the narrative is one of growth. While shadows may linger, Keppel DC REIT's future appears bright. In addition, Singapore is currently very focused on developing ways to harness artificial intelligence or AI as our next wave of economic growth. It was just announced that Singapore will be spending 70 million Singapore dollars to develop the first large language model or LLM with Southeast Asian context. Large language models are behind the very popular ChatGPT. I think this rising wave on the use of AI will boost demand for data centers in Singapore, where Keppel DC REIT has more than half of its portfolio in Singapore. If you found this exploration enlightening, hit that like button, share it with your fellow investors, and subscribe for more deep dives into the REIT universe. Don't forget to follow me on Instagram for bite-sized insights. Until our next exploration, happy investing.